Preparing for a finance manager at National Grid interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a finance manager at National Grid? I want to join National Grid because finance directly supports essential infrastructure and the transition to a lower carbon energy system. My experience in budgeting, performance analysis, and business partnering would help leaders make informed investment and operational decisions. I am particularly attracted to the balance between commercial discipline and public responsibility. As a finance manager, I would bring strong controls, clear communication, and constructive challenge while developing a team that delivers reliable information and supports long-term value creation. While answering, connect your finance leadership experience to National Grid's regulated networks, energy transition, public service responsibilities, and need for disciplined investment, forecasting, risk management, and stakeholder communication. Question 2. What do you understand about National Grid's business model? National Grid operates critical electricity and gas infrastructure, with activities spanning transmission, distribution, and related energy businesses in the United Kingdom and United States. Much of the model is regulated, meaning revenues and returns are influenced by regulatory frameworks, approved investment plans, and performance incentives. The business is capital-intensive and long-term, so finance must connect funding, project delivery, operating efficiency, customer outcomes, and regulatory commitments. That combination makes forecasting and accountability especially important. Make sure to cover National Grid's electricity and gas transmission and distribution activities, regulated and non-regulated operations, capital intensity, allowed returns, customer outcomes, and exposure to policy and energy market changes. Question 3. How would you build an annual budget for a regulated utility business? I would start with strategic priorities and regulatory commitments, then translate them into operational drivers such as customer connections, asset maintenance, project milestones, inflation, headcount, and financing costs. I would build separate operating and capital plans, challenge assumptions with budget owners, and model base, upside, and downside cases. After agreeing the plan, I would establish clear ownership, monthly variance reviews, and an assumptions log. That creates accountability and makes forecast updates more transparent. In your answer, discuss strategic alignment, operational drivers, regulatory assumptions, capital and operating expenditure, inflation, headcount, scenario analysis, challenge sessions, approvals, and monthly ownership of the final plan. Question 4. How do you explain a significant budget variance to a senior stakeholder? I first validate the number and split the variance into price, volume, timing, mix, foreign exchange, and one-off effects. I then compare actual performance with the approved assumptions and speak to the operational owner to confirm the root cause. My update would explain the financial impact, whether it is temporary or structural, and the corrective actions required. For example, delayed project spend may create a timing variance, but I would also assess whether delivery risk affects the full-year forecast. Be sure to mention separating price, volume, timing, mix, foreign exchange, and one-off effects, quantifying the impact, identifying root causes, proposing actions, and communicating clearly without becoming defensive. Question 5. What are the most important KPIs for a utility finance team? I would use a balanced scorecard rather than focusing only on profit. Financial measures could include EBITDA, operating cost performance, cash conversion, capital expenditure, forecast accuracy, and return on invested capital. Operational measures might include project delivery, network reliability, safety, customer service, and regulatory incentives or penalties. The best KPIs have clear owners, reliable data, and defined actions when performance moves off plan. That connects finance reporting to customer outcomes and operational decisions. Focus on financial and operational measures, including EBITDA, cash flow, CapEx delivery, controllable costs, regulatory performance, reliability, safety, customer outcomes, efficiency, and returns on invested capital. Question 6. How would you assess a major capital investment proposal at National Grid? I would assess the investment from both financial and strategic perspectives. That includes validating the need, regulatory treatment, engineering scope, cost estimate, delivery timetable, funding, and expected customer or system benefits. I would calculate NPV and IRR where appropriate, but also test inflation, delays, construction overruns, interest rates, and regulatory outcomes. Finally, I would define approval gates and a post-investment review, comparing actual cost, benefits, and timing with the original business case. In your answer, cover strategic need, regulatory approval, cost estimates, delivery risk, NPV, IRR, funding, inflation, sensitivity analysis, customer benefits, and post-investment review against the original business case. Question 7. What is the difference between operating expenditure and capital expenditure in a utility? Operating expenditure supports current period activities, such as maintenance, staff, contractors, and administration. Capital expenditure creates or materially enhances an asset that provides benefits over multiple periods, such as network upgrades or new infrastructure. The distinction affects profit timing, depreciation, cash flow classification, regulatory allowances, and performance reporting. I would apply the accounting policy consistently, document judgments, and involve project and technical teams early. Misclassification can distort both current results and future regulatory or investment decisions. Make sure to distinguish recurring operating costs from investment that creates or enhances long-term assets, explain accounting judgment, regulatory treatment, cash flow effects, and the importance of consistent capitalization policies. Question 8. How would you manage cash flow forecasting for a capital-intensive energy company? I would build a rolling cash forecast linked to the operating plan and project schedules. Key inputs would include customer receipts, supplier payments, payroll, tax, regulatory settlements, capital milestones, financing activity, and dividends. I would distinguish committed from discretionary spending and model downside cases involving project delays, inflation, or slower collections. Each month, I would reconcile forecast to actual cash, investigate timing differences, and update assumptions with budget owners. This keeps liquidity decisions grounded in operational reality. Discuss an integrated forecast covering operating cash, capital project schedules, working capital, tax, financing, dividends, regulatory receipts, scenario analysis, and regular reconciliation between forecast and actual cash movements. Question 9. How would you forecast energy demand or revenue when market conditions are uncertain? I would use a driver-based model rather than extrapolating prior year revenue. Relevant drivers could include demand volumes, weather, customer numbers, tariffs, inflation, regulatory adjustments, and market conditions. I would combine historical analysis with operational and external assumptions, then create base, upside, and downside cases. The forecast should show which assumptions drive the result and how sensitive revenue is to each variable. I would refresh it regularly and communicate ranges rather than false precision. In your answer, mention driver-based forecasting, weather, demand volumes, tariffs, customer numbers, regulatory mechanisms, historical data, external assumptions, scenario ranges, and transparent communication of uncertainty. Question 10. Describe a time you improved a finance process. In a previous role, monthly reporting required several manual spreadsheet consolidations and often produced late adjustments. I mapped the process, removed duplicate checks, standardized chart of accounts mappings, and introduced a controlled reporting template with automated data imports. I also documented ownership and review steps, then trained the analysts and business partners. Reporting became 2 days faster, late adjustments fell materially, and managers had more time for analysis. The key was improving both efficiency and control, not simply adding automation. Be sure to structure a specific example using situation, action, and result, emphasizing root cause analysis, automation or standardization, control improvements, stakeholder adoption, measurable benefits, and sustainable documentation. Question 11. How do you ensure the accuracy and integrity of management reporting? I start with reliable source data, defined ownership, and a documented reporting timetable. Before publication, I require reconciliations to the general ledger, checks on key operational drivers, analytical review of unusual movements, and sign-off from accountable owners. I use version control and maintain an assumptions log so changes are traceable. Where errors occur, I correct the immediate output and address the underlying control weakness. High-quality reporting depends on disciplined processes, not just a final spreadsheet review. Focus on reconciliations, source system controls, review thresholds, variance analysis, documented assumptions, segregation of duties, version control, audit trails, and clear accountability for data quality. Question 12. How would you prepare for an external audit in a complex infrastructure business? I would begin by reviewing prior audit findings, significant accounting judgments, new transactions, project balances, impairment indicators, and key controls. I would prepare reconciliations and supporting evidence before fieldwork, assign owners to requests, and maintain a tracker with clear deadlines. For complex areas, I would align early with auditors and technical specialists rather than waiting for questions. If an issue emerged, I would communicate it promptly, assess the financial statement impact, and agree a documented resolution. Mention planning early, mapping significant risks, preparing evidence, resolving reconciliations, assessing judgments, coordinating stakeholders, tracking requests, communicating issues promptly, and maintaining independence and professional skepticism. Question 13. Which accounting issues are particularly relevant to National Grid? Relevant areas include property, plant and equipment, and depreciation, because network assets are large and long-lived. I would also expect focus on impairment indicators, provisions for environmental or contractual obligations, leases, revenue recognition, deferred tax, foreign exchange, and regulated balances where applicable. Asset retirement obligations and construction in progress can involve significant judgment. My approach is to understand the underlying economics, apply the relevant accounting policy consistently, document assumptions, and involve technical experts when estimates are material. In your answer, discuss property, plant and equipment, depreciation, impairment, provisions, leases, revenue, deferred tax, foreign exchange, regulated balances, asset retirement obligations, and significant management judgment. Question 14. How would you manage working capital across a large utility organization? I would analyze working capital by driver rather than applying a blanket target. For receivables, I would examine billing accuracy, collection trends, aging, payment plans, and customer vulnerability. For payables, I would review invoice processing, purchase orders, contract terms, and supplier relationships. Inventory requires service level and critical spares analysis because excessive reduction could threaten reliability. I would set practical targets with operational owners, track cash impact monthly, and protect customer service and network resilience. Cover receivables, payables, inventory, purchase orders, billing accuracy, supplier terms, customer vulnerability, cash targets, operational ownership, and avoiding actions that damage service quality or supplier relationships. Question 15. Tell me about a time you challenged a senior stakeholder. A senior manager once proposed carrying forward an optimistic cost assumption to protect a project's approval case. I tested the estimate against supplier quotes, historical delivery data, and contingency requirements, then explained the downside risk constructively. Rather than simply rejecting the proposal, I presented a realistic base case, a stretch case, and milestone-based approval gates. The manager accepted the revised approach. It improved credibility with the investment committee and allowed the project to proceed with better risk visibility. Make sure to demonstrate respectful challenge, evidence-based analysis, commercial awareness, listening, alternative options, escalation judgment, and a result that protected value, control quality, or decision integrity. Question 16. How do you lead and develop a finance team? I set clear priorities and explain how each person's work supports business and customer outcomes. I delegate according to capability, provide regular coaching, and use one-to-ones to discuss both performance and development. I encourage analysts to present insights directly rather than only producing reports. At the same time, I set clear standards for control, deadlines, and accuracy, addressing issues early and fairly. My goal is a team that operates independently, challenges constructively, and keeps learning. Discuss clear objectives, role clarity, coaching, technical development, delegation, psychological safety, feedback, succession planning, workload management, and holding people accountable for both results and behaviors. Question 17. How would you handle a forecast that shows a project exceeding its approved budget? I would first validate the cost to complete, commitments, scope changes, contingency usage, and delivery schedule with the project team. Then I would separate genuine overruns from timing or accounting effects and quantify the likely final cost and cash impact. I would escalate through the agreed governance route with options, such as redesign, reprioritization, supplier negotiation, or additional funding. I would update the forecast promptly and document the decision, because early transparency creates more opportunity to mitigate the issue. Focus on validating the forecast, separating committed and estimated costs, identifying scope and delivery drivers, quantifying contingency, escalating governance, evaluating alternatives, and updating stakeholders without concealing bad news. Question 18. What role does finance play in the energy transition? Finance helps turn energy transition ambition into decisions that are affordable, fundable, and deliverable. That means evaluating grid expansion, electrification, renewable connections, resilience, and technology investments using robust cash flow and scenario models. We must consider carbon benefits alongside reliability, customer affordability, regulation, supply chain constraints, and execution risk. Finance also supports funding strategy and performance tracking after approval. The strongest contribution is not merely reducing cost, it is allocating capital toward sustainable outcomes with transparent trade-offs. In your answer, explain capital allocation, business case assessment, scenario planning, funding, carbon economics, regulatory uncertainty, affordability, risk management, and balancing decarbonization with reliability and customer value. Question 19. How would you assess the financial impact of inflation and interest rate changes? I would map inflation and interest rate exposure across operating costs, construction contracts, asset values, debt service, discount rates, and customer tariffs. I would then run sensitivities and scenarios, distinguishing immediate effects from recoveries that may occur through regulatory mechanisms or contract terms. The analysis should show EBITDA, cash flow, covenant, and investment impacts. I would discuss mitigation such as procurement actions, phasing, financing choices, or hedging, while clearly identifying residual risk and decision deadlines. Mention impacts on operating costs, construction costs, tariffs, financing expense, asset values, discount rates, cash flow, regulatory recovery, sensitivity analysis, hedging, and management actions to protect the plan. Question 20. How do you prioritize competing demands from operations, regulation, and senior management? I prioritize using a transparent framework, safety and customer impact first, then regulatory obligations, financial materiality, strategic importance, risk, and deadline dependencies. I clarify what decision is needed, what information is essential, and what can wait without creating exposure. If demands conflict, I make the trade-off visible and seek agreement from the relevant sponsor rather than silently overloading the team. This approach protects critical commitments while ensuring finance remains responsive and credible. Be sure to describe assessing customer and safety impact, regulatory deadlines, financial materiality, strategic alignment, risk, resource constraints, dependencies, and transparent communication when priorities conflict. Question 21. Describe a difficult financial decision you made with incomplete information. During a prior planning cycle, supplier pricing was uncertain but management needed an investment recommendation quickly. I identified the assumptions that could materially change the decision, obtained market input, and modeled low, central, and high-cost cases. I recommended proceeding only with an initial approval gate and required updated pricing before full commitment. That preserved momentum without disguising uncertainty. Afterward, I reviewed the assumptions against actual bids, improving the model and future approval criteria. Focus on defining the decision, identifying critical unknowns, using reasonable assumptions, quantifying ranges, seeking expert input, setting safeguards, acting timely, and reviewing the outcome afterward. Question 22. How would you use data and technology to improve finance at National Grid? I would first improve data definitions and ownership, because automation cannot fix inconsistent inputs. Then I would target repetitive activities such as reconciliations, reporting packs, and variance preparation using controlled workflows and dashboarding. Predictive analytics could improve maintenance, demand, or project forecasting, but outputs must remain explainable and governed. I would involve users early, test controls, and measure benefits. The objective is not technology for its own sake, it is faster, more reliable insight for better decisions. Discuss integrated data, standardized definitions, dashboarding, automation, predictive analytics, data governance, user adoption, cybersecurity, control design, and freeing finance professionals to focus on insight and challenge. Question 23. How would you manage finance risks related to major infrastructure projects? I would establish a finance risk view alongside the project risk register, covering cost, schedule, scope, procurement, contractor performance, financing, approvals, and regulatory exposure. For material risks, I would quantify probability-weighted impact and link mitigation actions to accountable owners. Monthly reviews would track commitments, change orders, contingency, earned progress, and early warning indicators. Strong governance gates are essential, because finance should challenge whether a project remains viable before additional capital is committed. Cover risk registers, cost and schedule uncertainty, procurement, contractor performance, change control, contingency, insurance, regulatory approvals, governance gates, early warning indicators, and quantified financial exposure. Question 24. What would you do if you discovered a material error in a management report just before submission? I would pause submission if timing allowed, confirm the error against source data, and assess its impact on reported results, decisions, and any external commitments. I would notify my manager and relevant stakeholders promptly, explain the correction clearly, and issue a controlled replacement rather than quietly changing figures. Afterward, I would document the root cause and implement a preventive control, such as an automated validation or independent review. Protecting trust matters more than preserving an artificial deadline. In your answer, emphasize stopping distribution if possible, confirming the error, assessing materiality, informing the right stakeholders, correcting transparently, documenting the cause, and strengthening controls afterward. Question 25. What would your priorities be in your first 90 days as finance manager? In the first 30 days, I would listen to the team, operational leaders, and key control partners while learning the business strategy, regulatory context, reporting cycle, and major projects. By 60 days, I would assess forecast quality, risks, team capability, and process pain points, identifying a few practical quick wins. By 90 days, I would agree measurable priorities with leadership, strengthen accountability, and establish a forward-looking rhythm that links financial performance with operational and customer outcomes. Make sure to cover listening and relationship building, understanding strategy and regulation, reviewing performance and controls, identifying quick wins, assessing team capability, clarifying risks, and agreeing measurable priorities with leadership. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.